First of all, Nicolai, thank you so much for taking the time to sit down. I know it's a very busy period, so I really appreciate it.
My pleasure, absolutely. Glad to be here.
If we go from the start, there's often talk about, getting the famous shipping bug in your blood and not being able to leave the shipping industry. Do you have a story on how you first got, interested in shipping? Was it coincidence or family related, or how did you end up spending your lifetime in shipping?
Family related, because as you're right, there's usually a story, and mine is I had a father, or I have a father, who used to be an S&P broker with Furnace here in Oslo, and he also worked in New York. So he was both sort of S&P and finance part of it, and his sort of feedback to me was also that if you want to go into shipping, also do the finance part, because traditional S&P broking might not be for everyone, but if you also have sort of a finance angle to it, that sort of opens up more doors. So that was always sort of the thinking. So I started working in New York after school, after college. Lost my job relatively quickly there due to downsizing so I was there for 3 months. But luckily I started working with Marine Money in New York, the sort of shipping magazine and conference organizer. So I spent 1 year with Matt and his team in New York, and then I left for London and set up their European office. Both magazine, the analysis in the writing, freshly minted, which we coined when I was there, and then the conferences. So and then in 2002-03, I think I told Matt McCleary, my boss, that it was time to get the real job. So I left, and after looking around and knocking on a few doors, I was lucky enough to land a position with Pareto in their shipping project department here in Oslo. Worked there for 10 years, and then in 2012 I left and started setting up what is sort of now become a fund management or management of other people's money in shipping. So that's really sort of sort of the 25 years since I've been doing this.
Wrapped up, but you just touched upon the time working for Marine Money, setting it up in Europe. How important has it been to be outside of Norway for quite some time and then come back, because shipping is so international, the relationship lasts, and it's a very global industry. So is that absolutely key to be outside to get the contact point and network, or in hindsight, is that a good experience to have?
Absolutely. I think it's not necessarily that you need it 100%, but at the end it all depends a little bit on what kind of shipping you're working. I think if you work as a market analyst, in a sort of big shipping company, maybe not that important. But if you're more sort of working towards transactions, relationships are more important, deal flow, then it's all more of the people So I think the 4 years that I had with Marine Money, not just because it was outside of Norway, but also because it was a very, we didn't have competition. We were sort of friends of the industry. The conferences. So when I left Marine Money in 2002, my Rolodex, which we had at the time, I was 28 years old. I had a pretty nice Rolodex. So I think that was one of the things that landed me, a good job at Pareto, because I knew, people in Greece, in New York, in Singapore, Germany, so I think that was, and it's, some of the people I do business with today are people I started, dealing with back in the Marine Money business. So I think the more transaction related, the more sort of commercially you work, the more important it is to have worked outside of Oslo. And I think even more now, as shipping activity in Oslo is not, it's not going up, it's going down, unfortunately.
Yeah. So you said, you spent around 10 years working for Presto Project Finance. Like, what are the toolkit you're building, and is it about pattern recognition, getting enough reps to understand the patterns and the financing, or what would you say is the toolkit you're building over the 10 years?
Well, definitely a mix, and I think it's the mix that is really the fact that it is a lot of tools. Not that you are particularly very good with one certain tool, because when in the project finance part of the business, when we put together these SPVs, in a sense you are creating a mini ship owning company every time. You set up an SPV, you arrange the financing, debt, equity. You find the lead investor, you put everything together, you do everything from sort of the formal accounting part. You are the CEO and the CFO of the company reporting to the owners, the boards. I mean, in a sense, you get sort of everything from commercial, investor relations, fundraising, for good and bad. I mean, you get to see everything for that particular. You see all the way, you have to read OPEX reports. I mean, the exposure you get to the industry, although you're sitting in, behind the Excel sheet, I think, for what I do now, I think it's that deep understanding that I just didn't raise equity, or just didn't raise debt, or just didn't read OPEX reports. We did sort of everything vertically instead of horizontally, and I think that vertical sort of deep dive. Having to write, shareholder letters when things didn't go as planned, which, especially after 2008, it was mostly those kind of letters. I think that, that's an important part of the sort of the toolkit that we use now when we manage other people's money and putting them to work in shipping. What to avoid, understanding, what risks can be avoided, what risks can't be avoided. So I think, so that was definitely, of course, a very important part of sort of the building blocks of what both me and my partner Willem, who was also an ex-Pareto colleague of mine, sort of what we took from there. Because when you are managing other people's money in direct investment funds like we do, you really have to you do a little bit of everything. We have to raise money, we have to look after, although we are co-investing. So it's very similar, but it's more sort of buy side than sort of being an intermediary. But and I think another thing, which is maybe the most important lesson, maybe not a tool, but it's a lesson, is that shipping doesn't exist in Excel. Shipping exists out there. And for us to be, when we started the fund management business, one of the first decisions we took was to be a co-investor, because I really understood that we could never be good enough operating, owning, buying, selling, fixing ships as ship owners. So why don't we see if we can co-invest with the people that do, because we will never be better than them anyway. And I think because we realized, I think, shipping works in Excel every time. You just change the assumptions and everything works well. OPEX is always flat in Excel. So it's sort of, to put it a bit jokingly, but I think it's important to understand. I think for us at least it was important to understand that shipping is, you need to be prepared for the unexpected, because the unexpected thing happens all the time.
That's a great point. So what is the most important transition from you entering the NRP system? Because you started sort of a fund yourself or with partners, and then you transition it over to the system here. So how was that journey?
Well, the first thing I did when I left Pareto was to establish a secondary KS fund, which we had thought about at Pareto, so it wasn't really sort of my original idea, but we never found the right structure whilst we were at Pareto to set this up, because we would be raising capital to buy things from our other investors, and either it went well and then the one part would be angry, and if it went bad the other, so it was just conflicts all around. So the first thing I did was to establish that. So it was mostly sort of friends, family, we put together, and that fund bought sort of 2, 3, 5, 7%, 10% stakes in KS from all the various providers. using that catalog that everyone, which no one really reads. And we always knew there was a lot of value if you just bother to read. So, and it was also the time when there was a sort of transition between tonnage, inherent tax and tonnage tax. So I was able to sort of do a little bit of, I wouldn't call it tax washing, but it was sort of, it was an opportunity there. So that was a start. And then 1 year later, I deployed that capital. I wanted to raise an additional fund which could also do primary deals. Instead of being 50 million NOK, maybe it was $25 million. But at that time, the AFM regulations, the sort of requirement to have a license to operate fund management business came from Brussels, and I think they were implemented June 30th in 2014. And for me, then it was really a sort of decision point. Do I want to build up a standalone fund management business with all that is required to do that? One, it's costly, so you need a certain AUM to be able to justify that. I didn't have that kind of AUM. Secondly, is that you need to be good at it, because it's your license to operate. I think it's quite boring. It's important. I understand the need, so I support it, but I personally think it's boring. And when I find things are boring, I'm usually quite bad at it.
Yeah.
And in fund management, you can't be bad at sort of the compliance part of things. So I approached NRP, which I had known since my days at Pareto. We were always very good competitors. I knew that NRP had shipping funds previously. I also knew that those shipping funds invested across the various providers of deals. They weren't tied to just one single arranger, because I felt that was important. They had the Torbjørn Pedersen, who was heading up the fund management business here at NRP, and who also managed those shipping funds. He invested with me when I was at Pareto, so I knew him. We had a good dialogue, so we started talking. They wanted to do shipping funds, but really needed the expertise. And I at least had some expertise, but I needed a place to be. So we did. So the first fund we raised was Q4 2014. We raised $27 million in Premium Maritime Fund number 1, which was then managed with a capital M by NRP, and which me as a sort of industry advisor sitting outside of NRP. Then we did that. We repeated that exercise in 2016-17 for PMF number 2. And when that was completed, fully invested, we sat down, the owners of the NRP group and myself sat down in sort of the spring of 2018, and I think we all agreed that this was sort of time. Either we sort of move apart and we go our separate, or we've been engaged for nearly 4 years, so maybe it's time to get married, and we all agreed it was time to get married. So then we established NRP Maritime Asset Management, got our own license. We moved the existing funds under that umbrella. I took my advisory contracts and sort of converted them into equity in the company, and started and moved into the offices at NRP, and sort of and together with the owners of NRP, we have been building, and now with Wilhelm, my partner, have been building up NRP Maritime Asset Management since, and that is now sort of what we do. So the company is owned by the partners and the NRP holding company. So we now have 3 funds under management, and are now for the next sort of month and a half, we are out raising capital for a new vintage of our funds.
Perfect summary. If I just ask like a more broad question, then we dive into the specific fund. Based on all your experience, everyone you worked with, seen, what do you think exemplifies a good shipping investor?
a good shipping investor needs to have you need to have legs. Also, you need to be patient. You need patience because shipping is cyclical, but you need to be able to afford to be patient. I think that's important. I think having a runway is important. To be a good shipping investor, you should have runway. You should not be too you shouldn't be too jumpy, too scared of shipping in terms of, things will happen. Ships collide, ships ground, engines fall apart, cargo gets spilled to the sea.
Yeah.
Things happen. Of course, now we have, you can add sort of more geopolitical issues. Ships get hit by missiles. I think you need to understand that that's part of the business, but you need to be able to handle when it happens. So I think partner risk is an important part of, maybe not the word partner risk, but alignment between the operational capital and the financial capital in shipping, regardless if it's through a stock listed company or if it's in a private sort of direct SPV kind of deal, to make sure that the people working on behalf of your money, the alignment needs to be in place. I think, and these are all things that we have sort of tried to put into our strategy when investing, because I think, of course, we are direct investors. We have, closed-end funds, 5 to 7 years. Of course, much different than being in and out of frontline on a sort of trading weekly basis. Completely different. But I think still, and there's a reason, there's a lot of reasons why I don't do the public market. I don't have psychology. I get to jump. I don't understand the stock market. But so I stick to what I do. But I think even when investing in stock markets, you need to understand, you want to pick the good, because you have 5 companies, they're all in the product tanker space, okay? So you would think that they should all perform the same, but they don't, because it is different. And one of the things you should look for is the incentive for management, to work on behalf of the shareholders, because the shareholders is really your money. And I think that's really what we're also trying to do when you do a direct investment, to make sure that the people on the ground in charge of preserving and hopefully making money on behalf of your money, they also need to make sure, and they won't do that unless they also get.
Yeah.
But you don't want to be in a position where, regardless of what happens, the ship owner gets rich and the financial capital just sits there and wonder what happened. I mean, because I think that's a lot of the perception from non-shipping, also investors that have chosen not to do shipping, is because they think that their stories is that every time they've tried, they always lose money, and for some reason the ship owner always comes out on top. And I think, but you need to start with alignments between the guy sitting or the girl sitting fixing the ship and the person owning the ship. It's just little things, I think, instead of trying to call Chinese coal imports the next 3 weeks, because I mean that's more of a bet. And you can make bets, but I think we try to avoid making bets.
So shipping is like almost a perfect example of like the butterfly effect. You can have one small situation that leads to another one, and to understand that and predict that, close to impossible. Exactly.
And I think, and then you sprinkle that with Black Swans, and you have no chance.
Exactly.
I think one example is second half of 2019. You had IMO 2020 coming. Everyone was that's what everyone was talking about. People position themselves into the product space, particularly in the product space, but also in the crude space, but most in the product space. And then, of course, you had the scrubber discussion and the spread discussion on top. Everyone was looking at this. 1st of January came, okay, it looked like everything had got it right. The people that sort of bet on the spread, the scrubber people, the ton-mile effect on the products. And then, mid-February, no one was talking about IMO 2020. We had COVID. And then if you haven't positioned yourselves to sort of withstand that type of black swan, you will be thrown off the train at the worst possible time, and you will wait 15 years before you come back in again. And I think positioning yourself for being wrong is a good thing because you're mostly going to be wrong.
Yeah.
But you might be right on the long term. But the thing is to get it right short term in shipping, at least the way we see it, that's betting. And we don't mind having luck. I just don't want to be dependent on being lucky.
Exactly.
I'm very happy being it, but I don't have to, because then I won't sleep at night. If something has to happen within a certain time, and if it doesn't, I'm in trouble.
Yeah.
Those kind of bets I don't take.
Exactly.
No.
So it seems like one of the key part of the investment philosophy in the fund is to reduce all the risk you can.
Yeah.
So can you explain a bit how you have done it? I mean, you have some, points you bring out now when you're raising a fund, but you have some specific things in place to reduce the risk, and that's quite essential, it seems, from your perspective.
Because I think, yes, it is, because I think that's really the only, I think that's what I charge people for. The management fee that our investors pay us, that is for doing work of reducing risk, because they don't need me to bet on OPEC quotas or the
real estate in China
or the water levels in the Panama Canal. People don't pay me to take that bet, but I think we think they pay us to reduce risk, because if our funds, most investors or all investors are looking for the optimal risk-adjusted return. That's sort of what everyone's looking at, to get the best possible risk-adjusted return. And if we have sort of said, okay, the return part of the equation we can't influence, we can't, and we know we can't influence. We know we don't know what's going to happen. We believe in long-term demand for shipping, but we don't know what's going to happen tomorrow, the day after, 2 months, 3 months, 4 months. So how do we improve the risk-reward ratio? If you can't do anything with the reward side, you have to do something on the risk. And then in shipping, there's a lot of risk. And then we have at least worked to identify, okay, what are the risks where we can actually make a difference? Fixing long term, in our view, that's not reducing risk. That's taking away optionality, taking on counterpart risk, which in shipping, so and so, unless you are, dealing with the big guys. So fixing long is not necessarily, we think, a good reducing. It reduces risk, but it also reduces upside. So what we are trying to find, okay, where are the places where we can reduce risk whilst keeping exposure to the upside? Because that is really where you should be reducing risk, because then the cost of reducing risk is very limited. So we have sort of decided, the important thing is what I touched upon is the partner risk, called the alignment between. So we like to co-invest with medium-sized ship owners, where the equity in the ships come to the office every morning and work. They come to the office. We are co-invested with next generation inheritance in reality. We think that's a good place to be. And then we want them to take a significant portion of the equity. We don't mind being minority. So instead of having the financial guys coming in with 90% and the owner takes 10 and he does 3% in fees every year, in 3 years he's got his capital back. So alignment between operational and financial capital is an important part. Secondly, we have at least chosen a access to the shipping market where we believe if you can take as little risk in the tool that creates the exposure, i.e. the vessel. We are full, we buy and sell in a market. So yes, we are fully exposed to the value development of that asset, but we don't want to take any other risk. So we don't like illiquid ships. We don't like specialized ships. We believe that in order to get the best riskless, or call it the lowest risk exposure to shipping, you should just buy the workhorse. The workhorse that has, it doesn't make more money than, but it always is out working. It can work everywhere. It has cranes. It can go into any ship. You're not buying a specialized ship that, unless there is significant demand from point A to B, that ship needs to compete with, other ships, or ice class, fantastic if you have the work, but if you don't, if you have to compete with, if you have an ice class ships running around in the Mediterranean during the summer, you're just a very thirsty vessel. So, and, so we like to buy mid-age, mid-size ships in tankers, bulkers, containers. And if investors want exposure to other segments, then they can do that on the stock market and get specialized LPG, LNG, car carriers, other types of exposure. But for us, so that's where I would say 99% of the ships we have bought over the last 10 years is in mid-size, mid-age, 10-year-old, Supermax, MR for the product, feeder ships. And then we own them for 3, 5, 6 years. And then at some time in that period, we sell them. Yeah. So I think
is it an even split between those three segments, tankers, containers, and bulkers? Or
I think over the last 10 years, it's been even.
Okay.
But the various funds have had different weightings. But if I would say that we are between 20 to 40% in each of those three segments.
Exactly.
So being diversified, we believe, is a cost-free risk reducer. It doesn't cost you anything.
Yeah.
Of course, if you put all your money in the big tankers and you get it right, of course, we would never be able to replicate that kind of return. But if you're wrong, you're history.
Yeah.
So again, we are trying to create something which has little as possible risk of losing money without and still being able to capture almost all of the upside. And we believe being diversified is an important surviving factor because it gives you legroom, it gives you runway. Because yes, the tanker market might be shitty, but the containers are doing okay, which means that yes, if we need to put more money into our tanker investments, that's fine because we make. And then when things start to fire up again, we are all the chips are on the table. And I think so if you look at our historical returns, which have been, I would say quite fantastic. It's not really the last 3 years that we go boasting about. It's the years from 16 to 21. We were never down, but that's when the toolkit, when we used all the tools in the kit in order to make sure that we had a full portfolio in 21 when things really started to take off. So I think it's, and the last part that we focus on, in addition to partner risk, liquidity risk, call it in the asset, and diversification, is having a sustainable break-even rate, because shipping is cyclical and volatile, and we like volatility, but you need to handle the volatility when it also goes down.
Exactly.
If you can't do that, then you're going to be in trouble. Because no one is, you will never just buy top and sell bottom. You're going to sit through cycles, and I think for us the key is to have. It's so much cheaper to buy runway today than when you don't need it, than to buy runway when you have to have it, when you're in trouble. Then buying a runway is extremely expensive. It could be dilutive for equity. It could be, it could cost you an arm and a leg. Or it can also make you do wrong things. You could fix long when you shouldn't, because it's the bottom of the market, and you fix long because you have to, because the bank is looking over your shoulder. So I think, or you sell in order to monetize because you need that money for something else. So I think having sustainable cash break even, which mostly is a leverage, starting leverage play, that's where the cash break even comes from. I think that's an important. Factor. So, partner risk, liquidity risk, or asset risk, diversification, and cash break even. And then the final sort of secret sauce we believe is that we don't do anything unless we have the right to call sale of the asset, because the ship owners that we co-invest with, we believe they are exceptionally good at buying ships, running ships. And most of them are also very good at selling ships, and if they're not, then we can help them. Because we are not building a ship owning company. We are investors. So we are a closed-end fund, or have closed, so we need to exit when we believe is right. And I think there's a lot of ship owners that ended up in ruin because they always wanted $1 more, because the neighbor got 18, they want 19. and they didn't sell at 19, they don't want to sell at 16, and they go down to 5 and they sell and they're broke. I think that's, and if you can buy mostly sort of 25% bottomish and sell 30% topish, you're always going to be fine.
Exactly.
Yeah. And I think, and since we have a product in shipping, or a fund product that, to be honest, no one really needs, you're not going to get a asset allocation company to go in and say, you should have 10% in a shipping fund. Which means that we need to make sure that the only way we can increase our following is to, of course, deliver good returns, but also sort of disprove all the sort of common truths about shipping, that it's either boom or bust, or it's cowboys. There's another angle to shipping, and I think that's what we have to do over time.
Yeah, that's a great summary. So another question I was keen to ask is, based on your business model, you buy into ships, you co-invest. So what is the perfect process to value and buy the ship?
Well, first of all, I think we try not to call the market.
Yep.
We look out of the window. We definitely look out the window. We see where the market is historically. But I think someone said, we had an investor meeting today, and someone said, don't you agree that it's difficult to find good investment opportunities today? And I said, I agree, but I thought it was quite difficult in 2016 as well. In hindsight, it was simple, but it was scary to buy a container ship in 2016 because, it made $8,000 a day. Now it's making $25,000 a day. It's more expensive. Does it make it easier? I don't know. I don't think, or more difficult. I think it's, again, so I think what we are looking for is our investors pay us to put money to work over the next couple of years. So the money we're raising today will be put to work over the next couple of years. That's our investment periods of 2 years, which means we're going to get an average entry point in shipping across the segments over 2 years. So, and if they don't believe in shipping, they shouldn't put money into our fund, because we will put the money into shipping. So we are more focused on doing the right type of investment in terms of, as I said, where we believe the risks are low as we can make them. And then we try to take the market risk. So I think it's more, for us, it's more important to find the right people we want to work with, who also believe that it's a good time to buy a ship. They probably know more about what is going to happen tomorrow or the next day than we do, because this is what they do. So I think it's difficult to sort of define. We try to avoid having any sort of set sort of parameters, that we don't buy ships more than 5% above new building parity, or we don't buy this unless it's a running cash flow. So we try to. So
it's not necessarily a checklist where you need to put all this. It's like.
But it's a checklist on those, the partner, the asset, these things. We need our trigger clause, all these things.
Yeah.
Sometimes it goes into pool, sometimes it's index linked with conversion rights, sometimes it's 1.5 year time charter. I think it's just an important checklist on those things. I think that's the important thing, more than. But if you looked at our previous fund, the 2022 vintage, which we just finished investing, we liked being diversified, but we don't need to be diversified as we build the portfolio. So for example, we did a lot of product in second half of 22, first half of 23, not so much since. Dry bulk we did throughout the 2 years. Containers we didn't touch until September last year.
Yeah. Because
we felt it was just way too expensive.
If you look at all the investments you've been part of, do you have anyone that stands out in particular that overshot or were exceptionally well investments?
Yeah, I mean, there are definitely a few. I think one is not because we hit the market particularly well, but it was the fact that when we build up these investment funds, we make sure we always have buffer capital. Because we have seen, both when I was at Pareto, how expensive it is not to have money when the investment needs money. The dilution is brutal. So some of the best investments we made. Maybe not in terms of absolute returns in dollars, because there was, but in terms of sort of IRR, is the shares we picked up from other shareholders who felt, who couldn't afford to be everywhere. They couldn't plug every hole. So some of the investments we did more of sort of where we increased our ownership. If you look at those investments in isolation, they are probably the best ones. But if you take some of these other deals, I think the best performing deals we did is probably, which is why we ask our investors to have a very wide mandate. Our strategy is clear. It's middle of the fairway, that's what we do. But we want to be able to sort of go into the deep rough if we feel that it's right.
Yep.
And we know that the risk of going out there, if we go wrong, is very expensive. Because then the investors say, we gave you the opportunity to go there, but you only went there and it went wrong. So we were able to pick up, not we, but with other investors, including a Norwegian company, we were able to pick up 2 car carriers coming out of a German bank. And although car carriers is not middle of the fairway for us, there were so many other elements that we checked all the lists, including the fact that when the German banks are selling assets, you should probably pay. At least it's worth running the numbers.
Yeah.
And we felt that the downside, again focusing, we felt the downside of buying those assets were almost zero, and it turned to be zero. But of course, we didn't see what was going to happen. So the fact that we got the sort of soft financing optionality, so of course the return on equity was fantastic when we exited those 4.5 years later. So I think, but mostly it's when all those boring investments in mid-sized ships have just all sort of performed well, and we've all been able to exit them. And I think maybe we're the period from 21 till now, it's geopolitical, a lot of it. It's of course a lack of order book, which is why we believe this is going to be high for longer. But I think we sold a lot of ships over the last 3 years, and selling ships in a very high market, to be honest, you would think it's easy, but it's not. Because when you're selling in you've never made so much money. So you're selling assets at a sort of 3 to 4 times, 3 to 4 year payback, which any financial, you should never do that. You should be buying. But the fact is, of course, you can't fix that contract. It's market. So I mean, yes, then you assume, and the only thing is that. So what we start to do is we have a strategy. When the markets are high, we sell the old ships. Because if the market turns, at least you got rid of the old ones, because the old ones won't have another round in them.
Exactly.
Yeah. So it's sort of, and then, so, I think we sold 12 or 14 container ships on that sort of peak. We started way too early on the old ones, but of course they were still good sales, but of course they would have been even better. But to be honest, we would never been able to sell most of it much higher if we didn't start early, because it's not like we're going to wake up and say, okay, 15 ships, it doesn't work that way. So
yeah. So the audience will probably recognize, several of the partners you have worked with, everything from Embassy Capital to Hafnia and many others, of course. How would you define, sort of the partnerships you have been able to build over the years? And how important has it been to have those, companies aligned with you? And yeah.
Well, I think the important, yes. I mean, without the alignment, I'm not saying it wouldn't work, but I think the alignment gets you through the difficult times. And I think, you mentioned 2, which are well-known names. We've done some deals with them, but most of what we do is sort of the small, medium size, depending on how you define small and medium. That's really where we spend most of our time. So I would say that
most of shipping is private, by the way, also for people. So it's like that.
No. So and these, these are really, the Greek ship owner with 5-6 ships. I mean, he's been doing it for 50. He's been through cycles. They know what they're doing, it's their ability to save on OpEx without, they know where to save on OpEx. More sort of, if a ship manager gets told to save, they will cut 10% on everything. But maybe you should do 20% on those things and don't cut down on something else, because we know that when we get to port, someone's going to, and then the buyer of that, ship, he's not going to find out for 2 years that where you actually saved on OpEx. So it's that kind of, that's what we want to buy into. Is those, the Greeks get accused of buying without inspecting ships. They don't. Yeah. I mean, they don't do, but they just don't do. They don't go around buying. They have some people that they know that already have been on board.
Exactly.
Which means they're, so we want to be. So what we have spent 10 years doing is actually to come to be put on as many friends and family lists for this, because there is a lot of co-investing, even in Greece, in Germany, in the UK, in Denmark, everywhere. So when they find a ship that they want to invite other people, we want to be one of those who gets invited. That's sort of what we have spent the last 10 years building up a stable of people, and I would say that's been a good strategy. We have so far we haven't sort of ended up in a partnership where we wish we didn't.
So now it's extremely exciting times. You're raising a new big fund on 100 million. The fundraising is going on right now. If you take us behind the scenes, how is a fundraising process in general, and what are the toughest questions potential investors ask you and your team?
Well, I would say fundraising for shipping is never easy, and it shouldn't be, but it's easier when the markets are good, but we have also increased the capital. So I would say it's probably going to be as difficult to raise 100 now than it was to raise 30 in 2016 when no one wanted shipping. So it's as hard, but we have a good, we have 10-year track record. I think what some of the investors, or I think most investors enjoy, is the fact that we haven't changed our strategy. We don't believe we can walk on water. So the strategy slide in the fundraising deck we're using now is the same as it was in 2014. It looks a bit nicer, but it's the same one. It is downside protection. I think, so that's what they like. What investors are concerned about is timing. Is that, are we, is this 5 minutes to midnight? It's the values are high. Some segments are very high. And historically they are. That's a fact if you just look at it historically.
It's a fair assumption.
Yeah, I mean, I think it's, if you look at product tankers today, a new building today costs you, I don't know, 50 plus. Last time I did that was, July 2008. We all know what happened in August. So yes, there are obviously signs that you could choose to, and they might be right. I don't think we're in front of a demand destruction as we saw in 2008, because that was not a general sort of market. That was just financial crisis. But I think at least our thinking is that long-term growth in ton mile, which is demand for shipping, has never been a problem. It's a problem when the world collapses. But even in 2009, in January, we were back at growth. So it was 5 months which was brutal, when the cargo wasn't moving. Same as start of COVID, cargo wasn't moving. Then of course shipping is the worst place in the world to be. But then all of a sudden you look out the window and that train has started moving again, because it's 8.5 billion people that still need to eat breakfast. They still need to heat their homes, and all these things come on ships. So I think the demand side, you just need to be able to withstand those sort of, but the problem has always been the supply. Yes, we do have an order book today that is higher than it was 2 years ago. In some segments it's very high. LNG, car carriers, large containers. It's increasing in some of the other more sort of segments that we focus on, but it's still historically not too bad. I think the average since 2005 is 20% plus. We are at 12, 13 now. So I mean, it's we're hearing that the constraint now is on main engines, even for ships that have been ordered. So you will see a pushed out delivery curve, which is of course good. Shipyard capacity it's been significantly built down. And even with an all-time high, close to all-time high new building prices, shipyards aren't. Some shipyards are, but we're not seeing it in a big. And if there was a lot of shipyard capacity that could just be turned on, they would be turned on by now. Because I mean the profit margins at the moment are fantastic. So there is, we think that it's going to, the next 2 to 5 years, 7 years is going to be volatile. But we believe the volatility is going to be, between the first and second floor and not the first floor in the basement. And then we will be prepared if it goes to the basement as well. And I'm sure one segment will be at some point. But the underlying growth story we believe in, we see, yes, of course, there is recession fears in the States, in China. Of course, China is still extremely important for shipping, but we stay away from the big capes, the VLCCs. We don't have the stomach, we don't have the capital to sort of play that. And I think if our investors want to play that as well, they should do it on the. Then you should go and buy Frontline.
Exactly.
If you want, or DHT, you should go. And if you want dry bulk, you buy belt ships. Or if you really want sort of play it, you go and buy Golden Ocean. Because if you get that right, we will never be able to compare, especially if you throw on some leverage. But I think it's, again, bread and butter ships that cater to the sort of, it's really what 100 million sub-Sahara African people are going to do over the next 3 years. That's what makes a difference. It's not what the West is not the marginal consumer anymore, unfortunately. So we don't drive shipping. So I think that's, so we believe in the growth story. We believe it's going to be high for longer, but volatile. But I think our strategy is able to cope with the volatility and capture the upside. And that's our value proposition, to be honest.
Yeah, I think that's a perfect summary. So just some quick fire questions at the end, Nicolai. So you have, of course, now a broader system inside NRP, and you have young people, you have experience. When you hire people to the investment team, what kind of qualities are you looking for when hiring people and setting a culture inside the investment team, etc.? Do you have a clear, idea on that as well?
Yes. Yes and no. I mean, we are a relatively small team, so I think the important thing is that it needs to work on sort of the chemical balance within the team needs to fit. There is no room for. We're not big enough to have assholes, and we need to sort of we all need to be able to go out and have fun. We need, because we sit in one office. It needs to be that part is important. I think we certainly only hire people that are way smarter than me and William, which isn't that hard, but it's important. We think it's better to learn smart people shipping than to try to get shipping people to be smart. Of course, there are people that are both. That's fine. Those are the best. We want to always recruit from below. So the 2 younger guys we have on our team now, we don't like mid-level, mid-management. So when they are ready to take the step, they will move up, and we will replace them with younger forces. Of course, people that like picking up the phone, aren't scared of speaking English, hardworking, but we spend so much time in the office, so we need to have fun.
Yeah, exactly.
That's an important, and it doesn't, and it's not fun if it's just William and me having fun. It needs to be fun. So I think that's, so we aren't looking. I mean, there's 4 of us. One guy came from Nordea shipping. He knew shipping more from a sort of banking side, but shipping. The other, he came from zero shipping. So, starting to work for us is shipping is not a prerequisite in any shape or form. No.
Do you see any new types of skill that comes in hand? Like understanding new technology or coding or stuff like that? Or is shipping still a fair, simple industry and you need to understand the fundamentals?
Or you need to understand that you don't understand the
Yeah,
fundamentals.
exactly.
I think that's more, at least that's where William and I are.
Yeah.
Because I remember when we actually interviewed with one of the guys that, that was, in sort of his, sort of call it case that he presented, he started really going off on sort of Chinese economy. You don't need to know that,
yeah,
because you don't know it. So I think it's, but of course, what's helped us tremendously internally is coding in terms of getting reporting, modeling, fund management, that part of everything. Of course, that's so to have someone who actually knows how, what Excel can really do if you understand more of it. In terms of this industry understanding, of course, the ESG or the E part, the CII, EU, carbon tax, ETS, I think it's important to understand. I think young people are both the combination more interested in it and they understand it because they've also they see it a bit around. I think as us sort of more oldish guys, we kind of could tell, at least we thought, we had a feeling that when we were getting sort of into Corona or to COVID, people were going to step off this ESG pedal a little bit. Because, when you can afford it, it's great. But back, when it's more difficult, it's back to bread and butter. Yeah. It's about getting things, which doesn't mean that shipping shouldn't try to pollute less. But, I think we need to, replacing 40,000 ships is not very environmentally friendly either to do it in short. So I think, to have an understanding of the EU, ETS, the CII, getting, that part of it, we are not making any bets on methanol, ammonia, hydrogen, dual fuel. That's not what we do. So.
Yeah. So another one a bit fun, there's been great times the last couple of years in shipping. Do you have any specific shipping companies or management that has impressed you?
Yeah, no, absolutely. I think it's impressive to see a combination, the two types of call it people that impress. It's that, as I was saying earlier, this how they are. Like when we're during COVID, the ship is being held back in port because someone was infected. The charter raises his hand, says off hire. And then you could tell that it's not big money, but some ship owners we had invested with, maybe were able, either they just took the off hire or they were able to maybe get it reduced by 10%. And then you have the other ones who were sort of always able to get it sort of 90% for the charter's account. Both because they had done a little bit of homework before and they bothered to actually, do the work of arguing. And I think that kind of, that's something we really appreciate. But then it's on the other side, which is sort of bigger, and you've seen it in trade rooms. We've been lucky enough to co-invest with the Logo Tetes family in London and New York, which is Lomar Shipping. Have a very good relationship with them. Very grateful that we have been able to sort of build and have an ongoing relationship. But one of the things that sort of impresses me is that they went from, and I think this was fairly in the press as well, that they, the summer of 2020, they had, I don't know, a huge number of new buildings in containers, plus a lot on the water. Not too happy times. And then the market took off. And instead of sort of, sitting still, I think they sold container ships in 22 and 23 for, I think, close to $2 billion. And that kind of sort of strategic moving in and out of a single segment. And I've known them since my Pareto days, and they've done this before in offshore, in and out of, I think it's, where you can see ship owners that don't necessarily have they're a proper ship owner with a long history, but they don't necessarily are tied to a single segment, or they also have sort of an investor, although they're private, and they know that, okay, someone in management now is going to be a bit concerned because all of a sudden we don't have any ships left. But that kind of sort of all in and then all off, taking profit, moving on. I think that's a cool thing as well. So.
I think that's a perfect ending, Nicolai. Thank you so much for taking the time. Good luck with the fundraising, and I hope we can do it again in the future as well.
Yeah, absolutely. Thank you for sitting down and talk with me.